was the singular message in your note this weekend about what we can learn from the correlations of these markets?
I think the main message about what's occurring in markets right now is they're responding to this global recovery that's taking hold. It's very early days in the recovery, but it's coming through in hard activity data in Asia and survey activity data in Europe and the U.S., and markets are responding to that. It may not be as forceful as it's been at other turning points because there are a lot of structural changes in economies because of this crisis, but that's definitely coming through in the data, is this idea of lift.
Employment is a lagging indicator. Can you take the economic suffering that so many are facing, particularly in the job market, and can you link that into the optimism of new signs of recovery?
Well, I think because most people are used to thinking of employment as a lagging indicator, they don't weight it at all in thinking about what asset markets are going to do over the next 3 months or so. I think they will start focusing on unemployment maybe in 6 months' time when they realize that, yes, we're getting a return to growth, but no, we're not getting a good enough improvement in labor markets. Then there will be doubts around consumption. This will feed views on earnings, and that's where you might start to see some headwinds in the risky markets. So people aren't paying attention to labor now, but I think they will be paying attention to it in a few months.
John, our markets are ahead of themselves. If you look at the equity markets, are they not pricing in the risk of a strong recession? Are they not, taking it seriously enough?
I think markets are slightly ahead of themselves, meaning it is very typical for markets to bottom before the recession is over. It's very typical for markets to retrace a decent share of their recession decline when the expansion is just starting. But the size of the gains that's been accrued over the past couple of months is essentially front-loading maybe the first 3 months of the expansion. That's a slight valuation problem. I wouldn't call it a large valuation problem. Had they already retraced everything that they had made or lost during the recession, had they retraced all of that across all financial markets, I'd say there's a valuation problem. But it's a small valuation problem, and it's certainly not echoed across all financial markets. EM and commodities have not retraced nearly as much as U.S. tech stocks have, and non-U.S. equities have not retraced as much as the U.S. has. So I think it's a very kind of market-specific call around where valuations are.